I want to discuss in outline what we're going to cover in the course that I've written, which is entitled Modern Portfolio Theory versus Value Investing and Warren Buffett. Where did you learn about investing? If you have an MBA, as I do, you will have learned to evaluate businesses using modern portfolio theory, the capital asset pricing model, the weighted average cost of capital, and discounted cash flows. However, you may have come to investing by learning from some of the great investors of the 20th century, like Warren Buffett of Berkshire Hathaway, and his approach is known as value investing. The two approaches come at company valuation, intrinsic value, and investment from opposite directions. One is very focused on financial theory, the other on business evaluation. They do actually overlap when it comes to discounted cash flows, thank heavens. This course aims to discuss these two contrasting approaches to help you to understand the merits and limitations of both. This lecture walks you through a brief summary of each lecture in the course and the intellectual flow of the course so that you will know what to expect. The course has 4 sections. Firstly, we look at value investing. Then we turn our attention and describe modern portfolio theory. We then, because we have to, reevaluate modern portfolio theory in the light of what we know about the real world. And then we talk about the importance of intrinsic value in investing. So, section 1, value investing. The basis of value investing. We start by defining what we mean by value investing. We look at its origins with Benjamin Graham in his book, The Intelligent Investor, a very highly recommended read, in my opinion. And we also discuss how Graham's approach has been developed by Warren Buffett and Charlie Munger, his vice chairman, at Berkshire Hathaway. The Berkshire Hathaway strategy helps us to understand the evolution of the value investing approach that has been created by Buffett and Munger. And we take a deeper dive into the Berkshire Hathaway strategy and Buffett's emphasis on sustainable competitive advantage. What do we mean by sustainable competitive advantage? Well, having introduced the idea of sustainable competitive advantage, we'll spend the next lecture explaining the 3 core business models that enable this. Durability and consistency of competitive advantage. As sustainable competitive advantage has to be both sustainable and durable, we explain what this means and how to recognize this when reviewing financial statements. Why is consistency important? Well, an important question to consider is why it is important, why consistency is important, and of course we'll answer that in this lecture in some detail. How to measure a moat? Well, moats are metaphors for sustainable competitive advantage. Think about a castle being protected by the moat that surrounds it, and we discussed how to recognize and measure them. Now we can turn our attention to modern portfolio theory. Having set out the basics of value investing, in the second part of the course, we turn our attention to modern portfolio theory itself. This is a contrasting approach focused on academic study rather than empirical market experience. So what is modern portfolio theory? We set out an initial explanation of modern portfolio theory and its origins with the work of Harry Markowitz from the Chicago School in the early 1960s. We then look at the capital asset pricing model and explain what this is and how it works. This links share price volatility to risk, which is the cornerstone of modern portfolio theory. The efficient market hypothesis is also critical, so we need to discuss it. This argues that as the market already has access to all available information, it's impossible to outperform the market. Without this hypothesis being valid, modern portfolio theory struggles to make sense. However, as a great many investors have successfully outperformed the market, I leave you at this point to make your own judgment as to whether the efficient market hypothesis is valid or not. In section 3, we have to turn our attention to the re-evaluation of modern portfolio theory. We cannot, in the light of empirical evidence of people performing well in the market, allow it to go unchallenged. We start by introducing Mr. Market. Mr. Market is an invention of Benjamin Graham in The Intelligent Investor. He is the antithesis of the efficient market hypothesis, and, to my mind, a much more credible explanation of market volatility. If you want to know what I mean, watch the lecture. We then re-evaluate risk, because we have to, and we start by decoupling our understanding of risk from share prices and look instead at the intrinsic risk within a business. So now we're turning our attention away from the market and prices and beginning to actually look at businesses themselves. And this is the core to this whole approach. When we re-evaluate diversification, which we have to challenge, then we have to look carefully and say, why does modern portfolio theory argue for diversification? Well, it does use diversification to try to counter market risk. But our interpretation is more likely to suggest that this is going to dilute returns towards the mean. And in striving to avoid underperformance, we manage to eliminate the opportunity to outperform. When we re-evaluate the efficient market hypothesis itself, we come full circle. And we have to take a more critical approach. If share price movements are not related to risk, and the efficient market hypothesis is a fallacy, we need a better way to judge business value. And for this, we turn to intrinsic value. So we have to then look in section 4 at the importance of intrinsic value in investing. We start by looking at Warren Buffett and value investing, because we can learn a lot from Warren Buffett and the way he's performed at Berkshire Hathaway, and we can discover that a practical approach is preferable to a purely academic one. We then turn to look at intrinsic value and value investing, and we review both the quantitative and the qualitative factors that Buffett relies on when making his assessment of intrinsic value. What do we mean by the margin of safety? Well, this is a key concept, again, which Buffett picked up from Benjamin Graham, and is a cornerstone of value investing, so we need to explain it. When we look at intrinsic value versus market value, we find these two concepts are very different, but easily confused when terms are not being used precisely. And as a long-term investor, you should focus on the first and not be distracted by the second. How to calculate intrinsic value? Well, without being overly mathematical, I thought it important to walk you through how to calculate intrinsic value from a practical sense. Market, book, and intrinsic value. Well, these are value benchmarks which are used by Buffett and Munger at Berkshire Hathaway, but not all are given equal priority. We also explore what can go wrong if you make an incorrect valuation. What does intrinsic value tell us about fair value? Well, intrinsic value helps us to judge for ourselves whether a company is fairly, and I quote, valued by the market. This makes the idea of fair value an important concept to grasp. Value investing strategies. We now discuss some practical approaches to value investing and how to identify investment opportunities in a practical sense. Value investing risks and pitfalls. I don't want to finish this course without warning you of some of the potential pitfalls you may face, which we do in this lecture. Warren Buffett's worst mistakes and how to avoid them. Well, of course, the great man is human. We unveil some of his worst investment clangers, all of which he's owned up to in Berkshire Hathaway shareholder letters over the years and the decades. So this brings our course and our argument to an end. Now, you may not agree with everything I say, but I hope you will find plenty of new ideas and information in this discussion as we compare and contrast value investing to modern portfolio theory. I will leave you to form your own view on which approach you prefer. So that's a walkthrough of this course that I've written which contrasts and compares modern portfolio theory with value investing and the approach taken by Warren Buffett at Berkshire Hathaway.